Welcome, everyone. Thank you so much for being here today. We are going to launch into our presentation on agency condo insurance requirements today. This is part two of a two-part series. We had part one a couple of weeks ago, and there were hundreds of attendees on that webinar. And again, today we have hundreds more that have decided to register for this event. We love putting on presentations like this. The entire team does, especially when we're so heavily involved in the review process and risk determination process for condominium and cooperative developments across the country, and for so many of our clients that have chosen to attend this call. So today we're going to be doing it a little bit differently. Usually I moderate these calls, but we've decided that we should put the best and smartest people forward today. Last time we had Lisa Geloso, who's the head of product and customer success at CondoTek, join me in the call and provide a lot of the information. And she will be moderating today with Dan Cerullo, who's our VP of Compliance and Risk Policy. And before we jump into it, I just want to outline a couple of things about CondoTek. As most of you, or probably all of you know, since we're so connected on this call, we offer several products in the industry. Our premier product right now is our Condo Project Warrant product and our Co-op Project Warrant product. And those products allow lenders to order not only the documents for review that are necessary for review with agency lending compliance, but also get a complete warrant and analysis of the condo project to make a determination on whether they want to lend in that particular property. That product has been met with tremendous applause throughout the industry over the last year or two, just because it's become a little bit difficult for the industry to make a determination on some of these properties, and having that third party in CondoTek has been, from what we've heard, a blessing for many lenders that we work with in the industry. We also offer our legacy product, the CondoPack product, which is our documents only service, and we provide that for thousands of projects a month across the United States. And we just introduced a new product called the Lending Compliance Report, which has kind of taken off in the industry, where HOAs and or new developers can order an analysis of their condo or co-op project, and we will provide the same analysis that we do in our Condo Project Warrant process through this service, and an ongoing subscription model through the service is also available. So condo and co-op properties can always know that they're in compliance or out of compliance with agency lending requirements. In addition to those services, we of course offer our new construction and existing established condo and co-op property project approvals, whether that's PERS or FHA or VA, or portfolio lending approval for a lot of our new construction developer clients. So thank you again for being here today. The one thing I want to mention is we have disabled the chat feature on this presentation, and we're going to rely on the Q&A feature. It's a button at the top or bottom of the screen, depending upon where you have it. So if you want to ask a question today, please utilize the Q&A feature of this presentation, and we will endeavor to answer any of those questions after the presentation. Most of what you're going to hear today is based upon the questions that were asked in the previous presentation that we provided. We went through what the issues were in the industry on the last presentation, and essentially gave an outline of what our thoughts were about each and every insurance issue that came up. And today we're going to really delve into those issues and answer a lot of the questions that were asked in the last presentation. And I think that this presentation is probably more advantageous to the lenders and processors and property managers and attorneys who are in attendance today. So without further ado, I'm going to hand it over to Lisa Geloso and Dan Cerullo.
Thanks, Orest. Welcome, everyone, and thanks for attending again. I want to welcome my partner in crime, Dan Cerullo. He's head of our VP Risk and Compliance, as Orest has said. He has a strong legal background, which is what myself and the team rely on, especially in the environment that we're in now, getting through some of the more complicated insurance type things that we're seeing in the industry. Do we want to bring up the PowerPoint so I can reference some slides, Orest? Orest and Dan, you're on mute.
Yep, here we go,
Okay.
Lisa. Co-insurance should be on your screen.
Thanks. Dan, I did want to open the floor for you for any opening remarks that you have.
Yeah, sure. First of all, thank you very much for that. And thank you to everyone for attending. The most important consideration I think that the agencies have tried to impart over the last few years is just this idea that, the guidelines are what they are, but, you're never going to get projects that fit perfectly in the box of the guidelines, or at least, it's very frequent to see projects that are outside of that box. And so the heart of the matter is we need to see insurance that has total replacement cost coverage, along with the additional, endorsements that they're looking for, covering the perils they're looking for, such that if there's a catastrophic loss, the value of the collateral that underpins the mortgage won't be unduly affected because the money will be there to rebuild the unit back to its pre-loss condition. And so whenever we're looking at these projects that are a little outside the norm, the COI is a little different, their coverage is a little different, there's an exclusion here, or we don't have this endorsement, but here's, why we don't carry that endorsement. I think it's always important to remember and go back to that. Are Fannie and Freddie, are your investor that you're selling to, are they left in a position where the insurance coverage is as good or better than sort of the baseline that Fannie and Freddie have proposed in their guidelines? And if you feel like your insurer is saying, we don't have inflation guard, but we have this, if it leaves them in that same or better position, it's something you can strongly look into utilizing. If, you're feeling like there's any room there where it's not, you're looking at red flags. And I think it's always just important to remember it doesn't need to necessarily fit perfectly into the box as long as you're meeting the spirit of providing that coverage they're looking for.
Okay. All right, thanks, Dan. Slide 1, coinsurance. I'm not seeing it.
Yeah, it's up on the screen.
Okay.
Dan, can you see it just to?
I'm not. I unfortunately just see.
Yeah, it's on the screen. Yep.
Okay. Well, so for the benefit of anyone who has joined previously and the benefit if you've just joined for part 2, I'm not going to reiterate the guidelines. Basically, we wanted to have the slide up so that you could be refreshed from the last time. And if you're a newcomer, you can kind of just come over the slide that's there now as Dan and I kind of go over our Q&A. Okay, so Dan, if a project has co-insurance, is it automatically ineligible, or do we still need to see an RCE or determination of value that's 100% replacement cost?
Yeah, I think first of all, co-insurance before and with the new guidelines that are coming, it doesn't make a project automatically ineligible. It used to create a lot of headaches, though. There were all these additional rules for co-insurance that were really guided to getting to that 100% replacement cost coverage, because that's what nullifies the co-insurance penalty that the agencies are so concerned about being levied on coverage. I think Fannie and Freddie made a really smart move with their recent guideline updates. They went ahead and clarified and sort of reemphasized that 100% replacement cost coverage issue is for all projects. It wasn't just for co-insurance. They especially wanted it for co-insurance. But what they've given us now is this clarity. They've removed all concerns about co-insurance. So whether the policy has co-insurance or not, you can kind of ignore that issue because it's all kind of prima facie going to be dealt with at the question of, have we verified 100% replacement cost coverage? When we can verify that, we know whether they have 80% co-insurance, 90% co-insurance, that they have sufficient coverage to avoid a co-insurance penalty. And so they've removed sort of, I think, the complications of the issue of co-insurance altogether, but that's really where we're at with the guidelines now. Co-insurance is kind of a non-factor, a non-issue overall.
Great. Okay. Slide 5, please. The replacement cost slide. Sir Orest, thank you. Okay. So what's the difference between guaranteed replacement cost and 100% replacement cost, Dan?
Yeah, this one comes up a lot. 100% replacement cost is sort of a term of art, but it is not super firmly defined. And so really, depending on who you ask, you're going to get a bunch of different answers. In some jurisdictions, they'll tell you that's not a thing. In other jurisdictions, they might tell you it's actually illegal under state law for them to say it's 100% replacement cost. But really, at the end of the day, if we look in the aggregate, the phrase 100% replacement cost is just a term of art that doesn't mean as much as it sounds like. I think most people, when they hear 100% replacement cost, they think what guaranteed replacement cost really is. But in reality, 100% replacement cost just means that your policy is written on a replacement cost basis, and you will be paid up to 100% of your property policy limit. Ideally, the policy limit that you have would be one and the same as your replacement cost for the project, the total replacement cost. But as the GSEs have kind of reemphasized, and as we probably all know from experience, that's not always the case. There's usually a large divide between how often you find that those two numbers line up. So, insurers sometimes pick premium amounts to sell a policy to an insured to try and be more price competitive. Sometimes the insureds want to underinsure because, they don't feel like the risk of a total 100% loss is that high. And then sometimes just over the years, like your replacement cost valuation versus your policy limit fall out of alignment due to inflationary forces. So, while it's always great when an insurer says 100% replacement cost coverage on an insurance certificate, you can't really take it at face value. You really need to go back and look for one of the pieces of information that Fannie and Freddie are prescribing that you get to verify that. And those are the 3 bullet points on screen from, I believe, one of our prior slides. And those are the replacement cost estimator and independent insurance appraisals, or a statement from the insurer that the coverage represents, total 100% replacement cost coverage equivalency. And again, you always want to be careful because they're going to use the phrase 100% replacement cost, but that is not necessarily one and the same as the limit for the policy is equal to the 100% of the estimated replacement cost. And that's a bit of a granular divide, but it's an important one. With regard to guaranteed replacement cost, this one actually is what it sounds like, and it's typically premium coverage. Sometimes when you have GRC, there will be a property limit attached. Sometimes there won't. It's sort of irrelevant because what guaranteed replacement cost coverage gets you is that no matter what, even if the limit they originally ascribed to your policy is too low, no matter what cost overruns there are, inflation, anything, you have a guarantee that the insurer will pay for the cost of replacement or reconstruction back to, like material and usage and everything. So you've got a guaranteed built-in 100% replacement cost coverage guarantee. And so I think, again, when people hear 100% replacement cost coverage, they think guaranteed replacement cost. 100% replacement cost is a term of art, does not mean that. So when you see guaranteed replacement cost, you're generally good to go. When you hear 100% replacement cost, you need to roll up the sleeves and you need to dig a little deeper.
So guaranteed replacement cost is as good as it sounds good. It's sexy. It's good to have.
Yes. It's
Okay.
it's the creme de la creme of replacement cost coverage.
Okay.
Before we jump off to the next slide, I think it's just really important to outline that, this is, the meat and potatoes of the insurance review, right? And we get lots of calls from across the industry from our lender clients and from, future lender clients because they've had a repurchase. And in many instances, we're seeing that this is kind of one of the big ones. So important to note, this is probably one of the most important things you'll garner from this presentation today. Thanks, Dan. Lisa, we're going to go to actual cash value.
Yeah. So let's talk a little about ACV. When we're talking about ACV, Dan, can you kind of talk about functional replacement cost and if that's acceptable within the term of ACV?
Sure. Much like 100% replacement cost, functional replacement costs and other qualifying terms, depreciated replacement cost, and any other number of terms of art that they might use in place of just the basic phrase replacement cost. You really need to dig down to what the insurer means by that, because everyone defines the term a little differently. And in many cases, it is used to obscure or limit the way in which these policies are paid out or the way in which the property was valuated. So when I see something like functional or depreciated replacement costs, it does put me on a little bit of a red alert. Specifically, obviously, we've got the agencies telling us policies that limit, depreciate, reduce, or otherwise settle losses at anything other than a replacement cost basis are not acceptable. That's verbatim from the guide. So what does functional replacement cost mean? Now, in some cases, what you're going to get from the insurer is, well, we can't guarantee that your 1940s high-rise or mid-rise in Manhattan can be rebuilt exactly as it was, but we're going to provide you with a functional replacement. It will meet all of the, design criteria that can be met and service the exact same number of units, the same type of heating and cooling, just maybe more modern elements. And, in those cases, that would be fine. Sometimes functional replacement costs can be used by an insurer to say, well, the roof's 10 years old, so here's what our replacement cost value is for the property, but keep in mind we've depreciated the roof by 10 years. Or functionally, we didn't include the landscaping costs that might be involved in a retaining wall because we didn't really consider that part of the replacement cost of the building. So you really want to drill down, what does the phrase functional mean to you as an insurer or a property valuation company, and not just sort of rely on, maybe a generic Google search or something like that.
So we just went over, so actual cash value is not allowed. What about the roofs?
Yeah, and like I said, we're seeing this more and more on properties with insurers. They're trying to limit when replacement cost coverage either drops off or never exists at all for things like the roof. And, it makes sense. Let's say you have a 20-year roof and it's 15 years old and you have a massive catastrophic hailstorm that just destroys it. You've already gotten 15 years of use out of that roof. So why should the insurer be paying you for 20 more years of roof? Shouldn't they just pay you for the 5 years of roof that you lost out on using? And it makes sense. It helps bring down premium costs for HOAs, this is going to be a recurring theme here, is HOAs want to bring down those costs. Insurers want to appear more competitive with their premiums to secure more business. The problem is, at the end of the day, it leaves the association, it leaves the unit owners in a position where they may be told, okay, well, here's your 5 years worth of money. And the unit owners and the HOA then have to scramble to come up with money maybe 5 years earlier than they intended to replace the rest of the roof. And the agencies don't want to be left holding that bag with regard to diminished collateral value. So they have reiterated very clearly, no ACV, no anything that's going to limit, depreciate, or otherwise settle it for anything less than full replacement cost value. And so whether it's ACV on the roof straight out of the gate, or maybe saying after 10 years, for instance, once a roof's 10 years old, then ACV is going to kick in. It's the same issue that's presented to the GSEs, and it's their same answer. No actual cash value. Every part of the policy has to be written on a replacement cost basis.
Okay, thanks. So just to reiterate, if I have a policy where I have replacement cost, except the roof's older than 10 years.
Yeah. say that would be ineligible under the fact that, and look, here's the thing, I get this question a lot too, or this variation of it. Well, okay, in 10 years, it'll become actual cash value, but today when I close this loan, it's still operating under replacement cost because they have several years till the ACV provision kicks in. The issue, obviously, that the agencies have is you might be closing the loan today. They're going to be servicing it for 15 or 30 years. And so at some point, that ACV is going to kick in. That risk level is going to drastically go up for them. And so for the same reason, they make those projects ineligible because they, even if the risk isn't there now, it will be eventually, or could be eventually.
Yeah, I think you make a really good point about servicing the loan and the thought process, you know, when you apply ACV and the roofs and the age and things like that. The same would be applicable for excluded siding and things of that nature.
Like if they said, you know, parts of the project had old siding or a
Or
type of siding
damaged.
they didn't
Yeah.
like. Okay. You know, I think we're in the same boat as roofs. Again, it's every part of the project needs to be settled on a replacement cost basis. And again, whether it's the roof or the siding or some element of the project that they don't like and they don't want to pay a full replacement cost on for one reason or another, you're leaving the value of the collateral at risk to be diminished, or you're going to see, for instance, if they have to come up with the money quickly and early because they didn't get a full payout for the cost of the replacement, you're going to be in a situation where they're levying special assessments or seeking loans, putting the financial stability of the project at more risk. And these are risks that Fannie and Freddie don't want to take. So really, I think the takeaway on ACV is going to be, if they start talking about it, you should run because it's not likely going to turn up. One caveat I want to throw into this. Sometimes we get insurers who are like, well, I can't really answer the question because the policy is more complicated than just replacement cost versus ACV. And they'll say, here's the full policy, you decide. You know, if you hit Control F and you scan it for the phrases actual cash value, in almost every boilerplate property insurance contract, you are going to find some terms that state the insurer can, in certain situations, elect to pay actual cash value. And that is not the same as being written on actual cash value basis. It's just that there are some cases you might have family heirlooms or other non-replaceable items where a replacement cost can't be generated because the object can't be replaced or is no longer for sale, etc. And they give wiggle room for the insurer to say, look, there's no way for us to agree on a replacement cost. Here's what its actual cash value would be, and we're going to pay that. It mostly goes to personal property and contents, but in some cases I have seen situations where it applies to certain elements of the building. That kind of stuff is not problematic. And so I think the real top level question you really want to ask is, what is the policy's loss claims payment basis? Is it replacement cost or is it actual cash value? If they say replacement cost, you're probably good. The idea being that the bulk of it is replacement cost. There will, of course, be some terms where they might have to pay you an actual cash value simply because there's no way to calculate the replacement cost.
Good stuff. Next slide is our agreed value and amount replacement cost. Are the GSEs no longer accepting agreed value, Dan?
I wouldn't say they're not accepting it. I would say they're not accepting it as evidence of 100% replacement cost coverage. There's a few reasons for that. I think the most telling is in removing the co-insurance section and emphasizing 100% replacement cost up top as every project you must verify. It's telling they didn't bring any discussion of agreed value or agreed amounts with it. And they just deleted that completely. And they gave us the recommendations to get a replacement cost estimator and appraisal, statements from the insurer, but nowhere in there did they say, oh, if there's an agreed value, we'll take that. And so I think that kind of indicates where they're at. They're not going to accept it as 100% replacement cost evidence. And the reason for that is, at the end of the day, yeah, a lot of times insurers are going to say, if we're going to agree to a value, we want that value to be the replacement cost of the project. But again, as we discussed before, in an effort to get premiums lower, in an effort to manage risk tolerances. There are cases where they'll agree to a value less than 100% replacement cost. And so that's kind of why you still need to go back and get one of the 3 types of verification previously discussed. I think an extra little note, just because of how prevalent coinsurance concerns were before, the guide always said you could use an agreed amount endorsement as evidence of 100% replacement cost. But if you look at the bold, the guide also said, but that agreed amount must be no less than the estimated replacement cost. So which is it? Is the agreed amount evidence of 100% replacement cost, or do I still need to verify that the agreed amount is 100% of the replacement cost? And the guide seemed to suggest the latter. So really, agreed value was nice. It was never a get out of jail free card. You were always needing to go back to verify that replacement cost when you had coinsurance. So I think they've eliminated the confusion over the matter. And I think they've also eliminated the ability to use agreed value as evidence of something. But when you see agreed value, it's a great time to go and ask the insurer, where did you generate your agreed value? How did you guys come to that agreement? Was it based on some sort of replacement cost estimate, an independent insurance appraisal? How did it come up? Because that might get you your statement from the insurer that allows you to prove it's not just agreed value, it's agreed value based on 100% replacement cost.
Okay, so let's advance to our next slide. Florida replacement cost. What do you do about Florida when there's coinsurance?
Okay, I mean, as we discussed, coinsurance is sort of a non-issue now, and so the same is true for projects in Florida. I know that Florida and coinsurance were synonymous with one another for so long because it felt like that 100% replacement cost verification requirement was tied to coinsurance, and Florida does tend to see a lot of coinsurance projects. But again, coinsurance, we don't need to worry about it specifically. We just need to worry about the 100% coverage issue. So I would say, again, you can kind of ignore the coinsurance when you see it in policies and on COIs now, and just remember we're calibrated for that replacement cost verification.
So in the state of Florida, the law doesn't allow an insurer to state 100% coverage. Can you talk a little bit about that? Because I think that could be really confusing.
Sure. And this kind of goes back to what I was saying above about what 100% replacement cost means around the country to different insurers, to different geographic regions. Florida, I think Florida is a state where they have a lot of statutes surrounding insurance now to prop up their insurance market. And we see a lot of insurers saying things like the law doesn't allow us to do X, Y, or Z. I think a lot of this is like marketing efforts. You can't, state things like guaranteed 100% replacement cost coverage unless that's part of the policy. You can't put things on the COI that would imply that. As we said before, the phrase 100% replacement cost can confuse people into thinking guaranteed replacement cost. But at the end of the day, if they can't state that outright, I understand. But we should still be able to get some sort of evidence that the limit is based on a reasonable estimation of what the replacement cost of the project is. The insurer should be able to confirm to you, yes, we ran some sort of valuation for the project, and the limit is in line with what our total replacement cost estimate was. There's wiggle room here. Same with the RCE issues in Florida, and getting those. So I know the insurers there have become very difficult to work with in some cases on these issues, and have used the state laws sort of like a shield to abdicate any involvement in going through these. But the reality is we should be able to get that type of information, even if it's not detailed, even if we're not asking them to put some sort of blanket statement like this project has 100% replacement cost coverage. We should be able to get them to say, we ran valuations and the limit matches or exceeds that valuation. And that shouldn't cause any problems, to be honest.
So when they say that they won't provide an RCE, the suggested cure could be getting a statement, and asking for that statement's not against any law or statute that you know of?
There is a lot of disagreement going on in Florida about exactly what that law means. And as I said, I feel like some insurers are using it a bit like a shield. And the legislature there has passed some overtly hostile legislation as regards to mortgagees' rights. So, there's a lot going on there. That being said, I've read through the statute too many times. And my take on it personally is just that what it prevents is from a mortgage insurer or a mortgage originator from demanding that the insurers produce a replacement cost estimate that includes proprietary information and trade secrets as to how they value projects, how they generate a premium based on that valuation, and things like that. Again, as I said before, I don't think any of these laws prevent them from confirming that the limit in place represents the replacement cost value of the project based on their valuation. Or they could just give you, hey, our RCE determined the project's value is this bottom line number. Because at the end of the day, none of that really shows how the sausage is made, right? You have no idea when they give you a number or say, yes, we think this limit represents the replacement cost of the project, how they arrived at that, how they valued certain items on the property, how they valued the risk elements in generating the premium. It doesn't tell you any of those things. And I think that's where, at the end of the day, if the insurer can't tell you those things, it's not because of state law, it's because they're unwilling to. And unfortunately, in those cases, we are in a pickle where we have to decline those projects, where you might have to move on from the loan because you're never going to be able to document your file in a satisfactory manner for Fannie and Freddie. And, I think Florida is going to discover that HOAs are going to need to start obtaining their own independent insurance appraisals on a more regular basis to keep up with GSE requirements and demands, because it doesn't seem like the insurance industry is going to come in to help bail out the HOAs or the mortgage bankers. So that's sort of where we're at. I have found that pushing back and being a little bit more aggressive, hey, I don't think that's what the law says. You should be able to confirm at least these basic points of information, and I don't need to know any proprietary data. It has worked. It doesn't work with all the insurers there, but it does work. I recommend trying that in a friendly manner, just pushing back and saying maybe we can find a middle ground. There's got to be something else. And in fact, as you can see on the slide that we've got now, I've kind of taken the prior slide and just shown, look, you're not going to get the RCE document. Great. But you can look for an expression of a single dollar figure. You can, again, with the third bullet point, you can't ask them to say, this is the limit that's based on the valuation.
Okay, just about the halfway mark here. We have about 7 or 8 more slides to go. So, Orest, if you could advance to perils and broad coverage. Okay, so is basic coverage acceptable for perils?
No, in most cases. There's outliers, of course. Some HOAs might get a basic policy from one insurer, then go and get peril add-on policies to meet broad coverage for Fannie or special coverage for Freddie. And to get the additional endorsements or maybe a deductible buy down and additional policies, but it's exceedingly rare. I think if you see basic, you're probably out of luck. If it's a very important loan, maybe you could dig a little bit. You have additional supplemental policies and endorsements, but it's unlikely. At the end of the day, Fannie's going to require all of those perils that are covered under broad form. They recommend special form, but they will take a broad form if it includes all the perils. Freddie requires a special form, and so that's going to be every peril as of 6/1. And basic without a massive lift is not going to be. I just like to throw in a quick word too about broad and special, as we discuss sort of the difference between how Fannie and Freddie look at them. At the end of the day, broad form is going to include a certain set of perils by default, and those can be found like in the Fannie guide at B7-3-03. And you want to make sure you have all those perils covered, of course. But with broad form, you can still have exclusions and additions to the peril coverage. And so you always want to be on the lookout for those. Same with special form. Special form, by virtue of being special form, covers all perils effectively, except for flood. And so you really just want to pay special attention. Even though you see special form, always be concerned, are there exclusions? Because in California, you can get special form coverage with wildfires excluded, and so you really want to pay attention to those types of issues on the policy. Don't just take that checkbox next to broad or special at 100% face value.
So let's talk about an example in the state of California when there's specific verbiage for wildfire exclusions. This seems to be different from fire coverage. Is that acceptable to have a separate policy for that peril?
Yes. Whether it's a state-specific peril exclusion, like wildfires in California, or maybe some sort of hurricane exclusion or named storm exclusion in Florida, or whether it's just a general peril limitation in some place where it's not geographically related, as long as you're covering those perils, they don't all need to be covered under a single policy. You could go and get your property policy from someone in California who says we cover everything except wildfires, and then walk down the block to another insurer, get a wildfire only policy. The trick is you always want to make sure that the supplemental policy's coverage is, again, equivalent to 100% of the replacement cost in case a wildfire is what causes the total loss at your condo. And so it needs to have the same coverage amounts and same endorsements as the other coverage, but it doesn't all need to be one policy. You could certainly get another policy. And I think one thing that you mentioned that was interesting, I think you said, treating fire and wildfire distinctly. That might be something that the California insurers are doing internally. We'll cover your fire, but we won't cover your wildfire. But typically, as far as distinct causes of loss or distinct perils under the classifications of broad and special, fire and wildfire really would not typically be treated differently. So when Fannie says explicitly you must cover fire, and when Freddie says you must cover fire, that would include wildfires. They're not a distinct coverage versus something like water and flood. Those are distinct coverages. So yes, flood damage is caused by water typically, but it doesn't ping your water policy. It pings your flood policy. In California, even if your insurers like we treat wildfires differently, Fannie and Freddie look at fire as a singular kind of peril.
So we had a specific use case that came up where they had special perils applied, but there was no coverage caused by a gas grill on the balcony that caused a fire within 25 feet of the building. Have we seen that before? I don't think I have. You may have.
I mean, I've seen all sorts of interesting exclusions and ways that policies get written to minimize risks. The grill issue, I don't know that I've seen it explicitly like this. Surely it's come across the desk maybe at one point. Look, obviously there's no clear guideline statement about grill fire-based coverage and things like that in the guide, but I think there's a good test, kind of going back to how I started out, and that is, does the limitation represent a hindrance to the association getting their 100% replacement cost coverage for a required peril? Okay, so if that's sort of the test that we're going to look at, then let's apply it. Here, the peril is fire, obviously from the grill. That's the concern. Somebody's misoperating their grill on a deck, and then the deck catches fire, or it's on the wood patio, what have you. So do we have 100% coverage for fire because fire's a required peril? And I think in this case, I would say no, right? You have 100% coverage for all fires except this type of fire, and that exclusion wouldn't be allowed. I doubt you're going to go and find an alternative insurer selling grill fire liability or, grill fire property coverage as a supplemental policy. If you can, great, God bless you. But overall, I think this would be one of those situations where, as they try and exclude certain risk elements, if it goes to a required peril, then you're not getting your 100% coverage. In fact, if there were a fire due to the grill, they would not get a payout of any kind. And that's what Fannie and Freddie want to see.
So maybe asking why. Can we ask why when there's exclusions? Is that appropriate?
I think so. It depends on the insurer because you get some insurers who don't want to cooperate. I've found many insurers though, they love to educate the industry, like it's a passion for them. And so I think it's important to go back and ask these questions because about half the time you're going to get a really insightful answer that helps educate you. And the smarter we all are on these issues like insurance that may not be our day to day, but are going to come up as we're underwriting, the better off we are. You're never going to make a worse underwriting decision with more information. So, one tactic that I see work really well is when you reach out to the insurer to get clarification on something that you think might be a concern, or maybe they're being a little cagey with their answers, just tell them why you're asking it. It's not a secret. Hey, we're trying to underwrite this mortgage. Fannie expects inflation guard for this reason. Fannie expects this peril covered without exclusions. And the rationale maybe is this. Do you think the policy meets that? And that's a great one to ask with the 100% replacement cost. We do this a lot. Look, Fannie wants it to be the limit to be set at 100% of the estimated replacement cost. I realize you don't have an RCE or an appraisal, but do you believe that the policy in question meets this? When you give them the reason you're seeking it, it feels less like you're trying to catch them in a gotcha and more like you're a collaborative team. And all of a sudden, I find that the floodgates open and they're like, oh, well, if that's what you're looking for, no, they don't have it, but they have X, Y, and Z. And here's why that's actually superior to the thing you were looking for. And that helps you build your case. You've built that relationship instead of coming in and being like, is there inflation guard? I want the RCE. There are a lot more cages like, what do you want our replacement cost valuations for? And I think that builds a bridge. So asking the why is great, and helping to educate them about the mortgage underwriting element might get them to help educate us about the insurance side of things and where we can find solutions and middle grounds.
Great. Thanks. Next slide, please. All right, so deductibles and per unit specific. Probably going to spend a little bit of time on this. Dan, overall comments and an opening comment on.
Yeah, I think I mentioned this a little bit before. It's a little bit of a theme. Obviously, higher deductibles mean lower premiums. Everybody loves a lower premium. Attractive to the HOAs, helps the insurer retain customers. The problem is the higher deductible, invariably, the less money you get when you have a loss, because that money is just going to be shaved right off the top of any payout you're going to get. So the GSEs have capped deductibles at 5%. The idea being you will get 95% of what you need to repair and replace your items, and effectively protect the collateral value of the units. The issue is.
Oh, I'm sorry.
Yeah, well, the issue is that there is going to be pushback then as the HOAs and insurers try and find ways to drive those deductibles up. And so we always want to keep that in mind. We're seeing it more and more, especially in certain markets like California, like Florida, where the insurance market is sort of in trouble. So it is an important issue. And I do know that we have a bunch of questions on this, and I'm glad we're going to spend some time here. So,
yeah, so I think you might have just answered. So when HOAs are put into a higher risk pool, that results in a higher deductible, which I think you talked about. The weighing of you add, you take away. Is there anything else that you want to chat about when it comes to being in a higher risk pool, or do you think we've covered that?
Yeah, I would just say I do remember in scrolling through the questions after the last webinar, somebody was concerned about a faulty sprinkler systems issue that was making them high risk. On-premises maintenance issues don't really qualify for these kind of deductible exemptions. Really, only per unit deductibles have an exemption available to them. But it's important that, if the insurer is calling them high risk and raising their deductible as opposed to it being to get a lower premium, that's not going to be something that Fannie and Freddie are happy about. So there's not really an exception available or any way to work around that. You either need to pay the higher premium to get the deductible down, get a deductible buy down policy, or the HOA is just not going to be eligible for financing. And I think it's important, like for instance, faulty sprinklers, there's no geographic component here. It doesn't have to do with the location of the project. What it has to do with is poorly maintained sprinklers, being a flooding risk. And, not for nothing, when you see these high deductibles and it's obviously not a geography driven issue, it's important for you to ask, like, what's going on here? These faulty sprinklers, the insurer thinks they're a flood risk for the project. Have they been repaired? Have they been replaced? You might be looking at a whole other can of worms with deferred maintenance and critical repairs. So sometimes the insurance is a window into other items of the project, especially critical repairs. And so don't ignore them, especially when you're seeing unconscionably high deductibles for something like sprinkler systems.
Let's chat a little bit about per unit deductibles. That would be our slide 10. If we have a deductible specific to an area, can the HO6 cover the amount over the 5% for that peril?
Yes. So this is the big exception here. And there's a couple key points. The first big key point is that it does need to be a geographic specific peril. So again, we might be talking about hurricane named storms in Florida, wildfires and earthquakes in California, maybe ice damming in colder climate regions. I think the important question to ask yourself is the high nature of the deductible driven by the geography? And you're going to find that certain perils, that's just not ever going to be the case. And then certain perils, it is. Wildfires and earthquakes being a prime example. So when you have those geographic perils that are a per unit deductible peril, then we can step on to the next test to see if we meet our exemption, which is, does the borrower's HO6 insurance sufficiently provide coverage to Fannie and Freddie? You got to cover that peril with a high deductible. You need to make sure that there's coverage for assessments levied on the unit owner for per deductible units. And then after that, we need to make sure that the HO6's insurance for that loss assessment coverage covers the gap between the 5% and the overage that is on the HOA's policy. And I do want to caution again, this is only for per unit deductibles. It is not for things like AOP or even like an earthquake deductible that applies to the entire building. It only applies to per unit deductibles.
What if the COI does not state per unit? We had some feedback saying that the COI rarely states like it's a per unit deductible.
I'm not sure if I'd agree it's rarely. I think we see it a lot in there. But, one important thing to remember is let's not just look at a COI. I don't want to look at full policies. Declaration pages are nice sometimes. Full policies are the worst. But, we do want to ask questions. I think a lot of times we go and say, hey, can we get a COI? And that you think that's the end of your insurance doc collection for the initial pass. It shouldn't be. There should be a number of questions that you're asking along with that COI request. Are there any per unit deductibles would be a good one. Getting those 100% replacement cost verification questions out of the way up front. So I would recommend asking those questions just to make sure the COI, it may not cover it. You've asked on the side. And just as a little shameless plug for our own product, that is something that we do at CondoTek on our CPW product. Every request for a COI comes with a set of questions for the insured to get that information. And so we recommend that, and it is our own practice.
Dan, we love shameless plugs. Please.
Yeah, I was just gonna. Oh my God, I was
that
just gonna
again.
say
Yeah.
that, Orest. It's
Yeah.
amazing. All right. So it seems the industry is seeing more per unit deductibles when calculated that exceed the 5%. Can the insurer provide a statement that keeps the higher per unit in place, but then caps the maximum deductible for the project at the 5% cap?
Yeah, it's weird. I hadn't seen this until like a year ago, and now it's all the rage. I think the goal is that it allows the HOAs to pass on a large amount of per unit costs to the unit owners when it's a limited loss. Pipes burst, 2 units damaged, let's make the unit owners pay. However, we're going to get ourselves a policy such that if we had a total loss, we're going to have a nice 5% cap on the policy. That's the rationale behind why we're seeing this. I think it's also part of the rationale is trying to get compliance with Fannie and Freddie requirements. So, That said, we haven't had a critical mass of these, so it's hard to say. I haven't gotten enough submissions in through PERS to say how Fannie and Freddie are really kind of reacting to this. My feeling is, though, if there is a cap that says the deductible can never exceed 5% of the building limit for any occurrence, you've certainly met what Fannie and Freddie are asking for. The one caveat I will throw out there is that there was a project recently that had just this exact type of insurance, and it was placed on Fannie Mae's unavailable list. I don't remember the name of the project. The question that we have at this point that we're waiting to kind of see how things shake down is, was that unavailable list, were they put on there because maybe this 5% cap wasn't brought forward by the lender to the agency for the review? Or did the agency review it, consider it, and say we don't like it? We don't know, and the unavailable list answers aren't 100% clear as to why, or as to whether this issue was considered. But my personal feeling, I think we're going to see this become acceptable because it does cap the risks to the project.
So if we get a letter of explanation, you need to make sure that you're
Very
submitting
firm
that
language.
LOX for sale and close to agency. Okay, and we are monitoring it. Dan and I are here at CondoTek. We're monitoring this specific instance. All right, so on a per unit, would ice dams in the Northeast be an example?
I think so. As I mentioned before, yes, you can get freezing temperatures anywhere in the country. However, you're not going to see unconscionable ice damming deductibles in Florida, right? Or in Texas. So, yeah.
We've had some feedback from our lender partners that both agencies had said that under no certain terms is water damage a geographic peril. So an HO6 would not apply if the per unit water deductible is over 5%, correct?
Yeah, I think so. Our experience is that you're not finding geographically driven exacerbations of deductibles from water. Water damage is burst pipes, the roof collapses, maybe you have a faulty condenser unit that leaks in an attic or something. Geographically driven forms of water damage are typically your flood policy. And so, unlike ice damming, where the deductible increase is driven by the geography, water, I mean, yes, you can get a few more burst pipes in the winter in Minnesota maybe than in Texas, but overall, the risk is not excessively changed by its geographic locale, and I don't think the agencies would allow this exception for excessive water deductibles.
Do you think that the agencies would ever consider getting rid of the words geographic on the per unit deductible?
No. Well, and the reason why is the whole reason for this exception is that there are certain perils in certain regions that an insurer just can't give you a low deductible on without an excessive premium. And so Fannie and Freddie don't want to exclude the entirety of Florida and exclude the entirety of California because you're not going to get an earthquake deductible at less than 5%, So they want to keep those markets open as long as they can shift that loss burden to somebody that's not them, in this case, the borrower. But Fannie and Freddie are smart enough to know that if they open the door to all deductibles, or at least all per unit deductibles, then you're going to create a moral hazard because HOAs are going to save money and pass all those additional costs and risks onto the unit owners. And that is something that Fannie and Freddie really don't want to see. They want to see the risk stay with the property and policy holder, who's Fannie or Freddie.
Okay, let's advance to our next slide, which was inflation guard.
Yeah, I think I'm fighting with somebody on the advancement here. There we go. All right.
Righty. So if a policy doesn't include inflation guard, is it acceptable that their reasoning is that the carrier renews the replacement cost annually?
Yeah, reviewed annually. Look, there's a lot of disagreement in the industry, and we work with a lot of partners who have differing opinions than us on this issue. So, I think I don't want to completely blow, your process out of the water. That being said, We've corresponded with the GSEs, and we have a lot of experience in submitting projects to Fannie and Freddie. And what we've been told is that adjusting the limits annually, even if based on an RCE, is not enough. And I think the rationale is kind of obvious. The requirement in the guideline is for you to have 100% replacement cost plus inflation guard. And if you have an RCE that shows the limit was set to 100% of the replacement cost as of the policy initiation date, that's great. You've got the first half. But the inflation guard is not sort of there for the annual occurrence. It's an ongoing occurrence. The idea that you get a little extra buffer in case your replacement has cost overruns due to inflation. Certainly we saw it during COVID and post-COVID building costs. So the idea is that on day one of your policy should be set to 100% replacement cost. But every day after that until the next renewal, you're going to see inflationary forces increase the cost of rebuilding and replacing. And that's why you need inflation guard in place so that you're covered for that increase, 1%, 2%, 3% increase over the course of the year. And so, there are areas where you might see other types of automatic increases that are over the course of the year. Those could function like inflation guard, even if they're not called that. But just setting it at the start of the policy term and saying, hey, we're accounted for inflation up to that date, that's not good enough for the GSEs. I will throw out there, extended replacement cost and guaranteed replacement cost. In many cases, these are superior to inflation guard. Certainly guaranteed replacement cost, you don't need to worry about inflation at all. They're going to replace it no matter the cost. With extended replacement cost, you get, again, another buffer. With extended replacement cost, it's usually somewhere between like 10 to 25% additional coverage on top of your policy limit. Most inflation guard is like 2 to 8%. So I think there are a lot of scenarios where you can be without inflation guard and still find a solution, whether that's some sort of automatic increase built into the policy, or whether that's I've got an extended replacement cost up to an additional 25% to cover me for any of those types of cost overages.
Okay. Let's advance.
Yeah, just
I'm sorry.
one second, just let me make a quick comment here. I have to say, look, the cost of insurance, again, we said it here in this slide, but they're surging. We're seeing cost, on average over the last 24 months raise at a minimum of about 25 to 30% for policies. And in some instances, close to 300% for policies. So these issues are so important because we're actually in the middle of seeing the problems that occur if you're not compliantly insured. So like dead smack in the middle of it. I'm sure the industry will come around over the next several years and comply as much as possible. But I have a feeling that there are going to be several uninsured condo and co-op properties across the United States. In fact, I know there are several that, God forbid, there's an instance or some sort of loss within those particular properties, that there's going to be a massive loss for the unit owners and the mortgagees. So sorry, Lisa.
No, that's okay. We're just at the top of the hour here with 3 minutes left.
Yep.
So with regards to the special coverage requirements, we had one question last week that asked if Freddie Mac requires all three parts of the business ordinance and law.
I mean, if you're talking about like the coverages A, B, and C, then the answer to that is yes. I know they don't spell it out like Fannie does, but they use the phrase as the all-encompassing. They do want to see coverage for all three, unless you meet the exceptions, outlined, because there would be no applicable additional costs for rebuilding and raising the property.
Okay, great. All right, last slide. We made it. 2 minutes left. All right. So on flood, is there a choice of ever not obtaining flood coverage?
Well, if you're not in a flood zone, you can certainly not. Look, at the end of the day, for Fannie, it's, are you in a special flood hazard area, a coastal resource barrier system, or, what they call otherwise protected areas? If you do, and for special flood hazard areas, it's a zone that starts with either an A or a V. There's like AX, AE, all those. If you're in a or V zone or a coastal barrier resource system, yeah, you got to have the flood insurance, unfortunately. The one hack to this but it's not really useful, with a loan closing coming up in 2 weeks, is if a project is in a flood zone, but based on a elevation certificate, we're able to determine that its lowest adjacent grade is outside the base flood elevation. You can get what's called a letter of map amendment from FEMA that effectively says, yes, your address is in the flood zone, but your property is built in such a way to be outside the 100 years floodplain risk. And with a letter of map amendment, your structure is removed from the flood zone. And that allows you to avoid the flood insurance requirement. Most homes don't qualify, some can. I mean, it just depends on how you're built, where the flood zone is on your property, how low your lowest adjacent grade is, that kind of stuff. But if you're in one of those zones, and you'll get a flood determination as part of your package. If it says you're in a flood zone, you got to get flood insurance. There's really no getting around it.
Dan, I think I remember the day about 12 or 13 years ago where we had a giant blackboard in my office and we were going over the LOMA process with FEMA. This has been a process that has, been in place, or a policy that is in place for a very long time, enabling condominium and cooperative developments to get removed from a FEMA flood map based upon the elevation. We haven't seen a lot of them, right? We have, a handful across the country have gone through the process. In order to get removed, it's a lengthy process, could take 6 months to a year. But yes, we've seen a couple of those across the country where those projects have LOMAs.
All right, we have one question left, and then we want to hand it back to Orest to do closing. So if you could stick with us for another 2 to 3 minutes after 2 p.m., we'd really appreciate it. Contents coverage is automatic with an NFIP policy, although private flood may not have the same calculations as the NFIP. Can you opine, Dan?
Yeah, I mean, of course, NFIP insurance is sort of America's standard flood policy, but many people opt for private flood insurance, either for premium reasons, coverage reasons, qualification reasons. There's nothing wrong with using private flood insurance. If you go to the guides for Fannie and Freddie in flood insurance, they'll give you very clear guidance. If we're going to drill down to the contents coverage question, though, they're right. NFIP sort of subscribes a contents coverage to their policies that's kind of a blanket, whereas you're going to see it be more specific and granular on a private flood policy. But at the end of the day, really, there's a simple test. Your contents coverage on that private flood policy needs to be the lesser of one of two things: either NFIP's maximum contents coverage, which is the coverage that they're putting in on the NFIP policies, or you can actually go lower than the NFIP maximum and maybe save some premium money. But for Fannie, you got to replace 100. You got to have coverage that's equivalent to 100% of the replacement cost value of the contents. And for Freddie, it's 100% of the actual cash value of the contents that are owned in common by the association. So the contents that are common elements. And these might be the front desk computer and the telephone system if it's not integrated, and furniture in the lobby and things like that. And I do want to note that key difference there. Fannie says replacement cost value. Freddie says the actual cash value of the contents. And while frequently it will end up not mattering, you do want to make sure that you're going down the right path, confirming what kind of contents you have, how is that valued, what do you think the value of it is, and you want to make sure you're paying key attention to those differences.
Well, that is definitely an awesome amount of information. This is why we love Dan. We go to Dan with all our complex tiebreaker questions. Really, thank you so much for joining us today. We do have some questions in the Q&A that we will most likely get back to you individually if you provide a valid email address. And I personally want to thank you for this wonderful turnout and allowing Dan and I to chat with you about all things condo insurance. And I want to hand it back to Orest.
Thank you. Boy, I'll tell you, I love showing off. I'll tell you, especially when we have such knowledgeable and individuals that have been in our organization for such a long time. I'm so proud to have these team members be able to present to you today. It's interesting. The market is shifting right now as a result of all these guidelines. And I want to thank Dan and Lisa for their time and their efforts in putting this presentation together. What we can absolutely glean from this is that, look, there are a lot of condominium associations across the country that are not going to be compliant with current lending policy as it relates to insurance. This has happened before. This is not a new thing where the industry has shifted and the associations have to catch up. I could tell you that we're in near constant discussions with insurers, with large carriers across the country, with getting them to understand the policies enacted by the agencies and what the requirements are. And we see some movement there within the industry. So I think it's going to get better. In the near term, there are a lot of properties that are not going to be compliant with these current insurance policies. Some of them can be changed very quickly. Some of the policies can be changed very quickly. Some require a unit owner vote in order to do so. I mean, we've seen a lot of difficulty over the last, 6 months to a year. That being said, as Dan, so thoroughly outlined, asking the appropriate questions, asking the questions of insurers the right way when you're reviewing these projects is something that we specialize in. And I'll tell you, I couldn't recommend more our Condo Project Warrant product. I think the ultimate goal for us in the industry, or the place where CondoTek will eventually be, is to be the organizations that a lot of the homeowners associations go to first to get compliant and to get their projects looked at and properties looked at, to determine whether, how to fix them in order for them to be compliant. And again, that's why we started offering our lending compliance report product, and which is frankly just surging. So I think that eventually the lenders who are on this call are going to get that the benefit of us working through so many thousands of developments across the country and trying to get them compliant. So again, thank you everybody for attending this. This presentation will be available on our blog and will be sent out to everybody who registered for this event. And I can't thank Lisa and Dan enough. I couldn't be more proud to be a part of this organization today. And thank you for your time and all your effort. Thank you, everyone.